Hello, Patrick Dwyer here at NewEdge Wealth, and I'm here with my partner, Anneke Niemira, who is a wealth strategist. What does that mean? It means she's an attorney. She has an LLM in tax, and she's very smart, and she helps our founder clients really to solve the problem of making sure they get QSBS qualified, basically making sure they get tax-free status on a portion of their founder stock, and make sure that they engage in something that's called sacking, which is really move some of these shares to other entities to really maximize tax benefits in the code. And so this is going to be short and sweet, and we're going to talk about two different types of founders: a founder who is not married. We're going to talk about a founder who is married or has kids, and the strategies they would have, and then how we would help you get this done at NewEdge Wealth. So with that, what is QSBS?
QSBS is qualified small business stock. It's where you can exclude up to $10 million of long-term capital gain on a transaction of a business sale for every taxpayer who owns that original issuance stock.
So that's 10 million per person who has stock.
Exactly.
So in one family, you could give stock to 5 different people in your family, and each person would theoretically get up to 10 million.
Exactly.
Right?
Yes.
And, all right, super. So obviously, this is important for somebody to take a look at. So they have to be a C corporation, but they can convert from an S to a C, and it's going to be 5 years. Well, let's talk about the type of founders. We have a lot of founder clients, and typically a lot of them are single. They're not married. How typically would they approach maximizing, getting more than 10 million out if their value of their business is under 50 million? How would typically they look at that?
I would say that, generally speaking, you can have a trust that you've created as long as it's its own taxpayer, get its own $10 million capital gains exclusion, which can be really effective, as you said, for this stacking concept. So what I've seen is that if you aren't yet married, you don't yet have children, that you can create a trust and perhaps use a family member, another family member, say a sibling or a parent, as your placeholder beneficiary. So you might say, I'm putting this trust together for my brother and my future spouse and children. And that way the sibling is that placeholder until you have those other family members to kick in, and you're still able to get those assets away and tax benefited.
So if you're lucky enough to have a lot of siblings, you can really do a lot of sack, right? And if one could have stock that's going to go to your future wife, one could have for your kids, but there are ways to do this. They're not impossible. Are there any other benefits, like some asset protection or protection from a divorce in the future for marriage that hasn't happened yet?
Absolutely. One of the best perks of an irrevocable trust are that it does give you creditor protection. So we see that all the time. If you're in a particular litigious business, or you get sued, or you get divorced, that those assets are not reachable in case of divorce and cannot be kind of pulled back out of the trust and given away. So it's a fantastic creditor protection benefit.
I think that's very important, because typically folks in their 20s haven't, been through a lot of life's problems, which the longer you live, the more likely you are to go through them. And one of the things you might want to do is make sure you button some of the things up, because it's a tremendous amount of work that goes into these companies. I mean, it's so hard to build these companies. It's incredibly difficult, and people just don't appreciate, how much goes into this. And so let's say you're a founder and you're married and you have kids, or you're about to have kids. How would they approach this?
I think similarly, you would create irrevocable trusts, and you could have husband creates an irrevocable trust for the benefit of wife. The trust is its own taxpayer. Wife does the same thing for husband, ditto. And now you have these irrevocable trusts that can each get their own $10 million capital gain exclusion. And we still have that creditor protection we were just speaking about as well, precisely because they are irrevocable trusts. So it's a win-win.
Yeah. So if you have a family, there's a real opportunity to push some of those assets down to your kids, and then move that from your state. And your kids now have the potential to become, if you're successful, to be incredibly wealthy, which may or may not be a great idea, but it's definitely something I think people should really look at, because taxes are real. We're going to have taxes in the future. Last but not least, most young founders, the last thing they're thinking about is estate planning, because you're young and you're not likely to die. Could you just explain a little bit about what the state tax exemption is? Because I think it's relevant to founders, especially if it goes really well. And also they need to think about a little bit about when they're gifting to your parents. If they're already wealthy, there are other things that we need to consider. We'll just mention that briefly, just what the exemptions are.
Absolutely. So the current federal estate tax exemption is 13.61 million. It indexes every year for inflation. So that is the amount you can pass to others without paying any estate tax. If you're over that amount, the estate tax rate is 40% on every dollar over that 13.61 million. Also of note, after 2025, that is expected to revert down under current law to half of that number. So it is a great time to plan right now and use the exemption if you can afford to do so. And before that exemption goes down and we lose some of that upside potential.
So let me just say that back to you, make sure I got that right. It's each individual has $13 million of wealth that is exempt from state tax, and everything over that's taxed at 40%. And that's going to get cut in half at the end of next year if the Trump tax plan.
If Congress does not change the law. Exactly right. Exactly right. Yes.
At the end of next year. So that's also something to, especially I think a lot of families, if your parents are wealthy and you're gifting them stock, that may not be the greatest idea in the world, in the sense that, if they're 70,
they're going out generation, you're going to end up with tax again. So you should aim down generation or laterally into trust. Absolutely.
So let me describe to founders what the process is we take you through on our team at NewEdge Wealth. So first off, we don't charge founders any more than 0.5% on their liquid investments. What we typically do is a planning engagement with our wealth strategist, and we will build a financial model for your family. Typically, founders have to husband their liquidity because they don't have a lot of it in the first 3 years. Typically, our founders have 2 million to 10 million that they've taken off the table, and they're using that to enhance their lifestyle. And a part of it, they're using to grow long-term. And we're typically going to try to be extremely low cost and tax efficient using platforms like Vise. And then we use software like Arch to connect in and organize all of their privates. The planning process that we take through with our team is really around structuring things in such a way that the founders have confidence that they have a good strategy and that they can call us as their thought partners when an opportunity for a secondary comes, when they're getting ready for a sale. We're ready to go. We can plug things into our model and give them the answers that they need as they begin to make their own personal life decisions. And because we only work for that fee, we only work for the client, they understand our interests are aligned. And would you like to add anything about what your team adds to this process? Because you're actually doing all the work in this part of the job here.
I think the main goal, right, is to make sure that we're looking at everything holistically. We're understanding what your attorney's done for you, what your CPA's done for you, what we can do for you to put it all together and make sure that your entire plan is cohesive. You have enough for yourselves and that you're planning efficiently for the future.
Finally, I'm going to say, how do we execute on this to make, because these founders are typically working, insane amount of hours. I'm having calls with founders on Sundays because that's the only time they have free. What we do is we're going to ask you for whatever information you have, your estate planning documents, if you have any information on your company stock, what your balance sheet looks like, your bank and brokerage statements, any life insurance. And we're going to have these planning calls, and we're going to set this up. When it goes to execution time, we're going to help you hire an attorney. Our wealth strategy team will go to the meeting virtually with the attorney and push this process. We're going to give everything all wrapped up in a bow to the attorney so it's organized. And then we're going to review all the documents on your behalf and make sure that everything is the way you want it. And so you can continue to focus on your business because that's where you're going to build your wealth. We just want to make sure that we do all these things correctly so that you can win. Thank you very much for the time. We really appreciate it. We love working with founders at NewEdge Wealth.